Welcome back to the Personal Finance and Investing channel and to our deep dive into one of the most perplexing questions in the world of finance. When stock prices drop, where does the money go? It's a question as old as the stock market itself, reminiscent of those odd moments when socks disappear in the dryer. Just like those socks, the money seems to vanish into thin air. But unlike household mysteries, the enigma of the stock market has a logical explanation. Today, we're going to unravel this mystery, exploring the fundamentals of stock market dynamics, investor psychology, and the economic principles that govern the flow of money in and out of the market. Understanding stock market fundamentals. The stock market is a vast and dynamic system where billions of dollars circulate daily. It operates on principles of supply and demand, influenced heavily by investor sentiment. When a stock's price decreases, it might feel as though money has simply disappeared, but in reality, the value has shifted in response to market conditions. This segment explores the foundational aspects of the stock market, emphasizing how fluctuations in stock prices represent changes in perceived value rather than the physical movement of money from one party to another. The role of investor sentiment. Investor sentiment plays a pivotal role in the valuation of stocks. It's the collective attitude of investors towards the market or a particular stock, driven by news, reports, and global events. This sentiment can lead to rapid increases or decreases in stock prices, reflecting the psychological aspect of investing. Here, we delve into how investor sentiment affects stock prices and what happens when there's a shift in market perception, leading to decreases in stock values. Buy and sell dynamics. At the heart of the stock market are the buy and sell transactions that determine the flow of money. When you purchase a stock at a certain price and later sell it at a lower price, the difference represents a loss on your part, but not a direct transfer of money to another individual. This section breaks down the mechanics of buying and selling stocks, illustrating how losses are realized and what they mean in the broader context of market economics. Exploring short selling. Short selling is a strategy used by some investors to profit from the decline in a stock's price. It involves borrowing shares and selling them with the hope of buying them back at a lower price. This concept might seem like a direct beneficiary of stock price drops, but it's an independent transaction with its own risks and rewards. We'll examine short selling in detail, explaining how it works and its impact on the market, especially during periods of volatility. Supply, demand, and market capitalization. The fluctuation of stock prices is fundamentally a result of changes in supply and demand. Market capitalization, or the total value of a company's outstanding shares, adjusts with stock price movements, influencing the overall market perception. This part of the video focuses on the dynamics of supply and demand, market capitalization, and how these elements interact to determine stock prices. Implicit versus explicit value. A stock's value can be viewed through two lenses, implicit and explicit. The implicit value is subjective, based on investor perceptions and future expectations, while the explicit value is objective, grounded in the company's financials and assets. We will explore how these two types of value contribute to the price of a stock, and what happens when there's a disparity between them. Perceptions of value and market movements. The stock market is as much about perception as it is about reality. Changes in investor confidence can lead to significant market movements. This section delves into the psychological aspects of investing, discussing how perceptions of value can lead to increases or decreases in stock prices, effectively causing money to disappear from an investor's portfolio. Economic indicators and their impact. Economic indicators play a crucial role in shaping investor sentiment and consequently stock prices. From employment reports to GDP growth rates, these indicators provide insights into the health of the economy, influencing how investors value stocks. We'll examine the most critical economic indicators and their direct and indirect effects on the stock market. Strategies for navigating stock price drops. Experiencing a drop in the value of your investment can be disheartening, but it's a common part of the investing journey. This segment offers strategies for investors on how to navigate these situations, including the importance of a diversified portfolio, long-term investing, and not succumbing to panic selling. Thank you for joining us on this exploration of one of the stock market's most intriguing questions. If you found this video enlightening, please like, share, and subscribe for more insightful content.